This video provides an overview of the major concepts covered in Chapter 5, Monetary Policy. Chapter 4 discussed the Federal Reserve System and the ways that it controls the money supply, which is information essential to financial market participants. It's just as important, however, for participants to know how changes in the money supply affect the economy, and that's the focus of this chapter. Chapter 5 is comprised of 6 key learning objectives. First, to describe the input used to determine monetary policy. Second, to explain the effects due to the Fed's implementation of a stimulative monetary policy. Third, to explain the effects due to the Fed's implementation of a restrictive monetary policy. The fourth objective is to explain the trade-off involved in monetary policy. Fifth, to describe how financial market participants respond to the Fed's policies. And finally, to explain how monetary policy is affected by the global environment. Let's begin with inputs used to determine monetary policy. Given the Fed's goals of controlling economic growth and inflation, as we saw in Chapter 4, the Fed considers the indicators of these economic variables before deciding on the proper monetary policy to implement. The Fed monitors indicators of economic growth because high economic growth rates creates a more prosperous economy and can result in lower unemployment. In addition to GDP, national income, and the unemployment rate, numerous other leading factors are used to predict future economic activity. Here's a list of some of the commonly used leading, coincident, and lagging indicators and indexes to help drive monetary policy decisions. To support the second goal of low inflation, the Fed closely monitors price indexes and other indicators to assess the U.S. inflation rate, such as the producer and consumer price indexes. Other inflation indicators might include wage rates, oil prices, and gold prices. Now let's discuss the effects of a stimulative monetary policy. To illustrate how the stimulative monetary policy affects interest rates, the left graph of this exhibit shows the demand for loanable funds, D1, and the supply of loanable funds, S1, before the Fed implements its monetary policy, which results in an equilibrium interest rate, I1. If the Fed's stimulative monetary policy leads to, say, a $5 billion increase in loanable funds, then the quantity of loanable funds supplied will now be $5 billion higher at any possible interest rate level. In response, the supply curve for loanable funds shifts outward to S2. Given the shift in the supply curve for loanable funds, the quantity of loanable funds supplied exceeds the quantity of loanable funds demanded at the interest rate level I1. The equilibrium interest rate will therefore decrease to I2, the level at which quantities of loanable funds supplied and demanded are equal. As shown in the graph on the right, once the equilibrium interest rate declines to I2, the level of business investment in new projects increases to B2. The reason for the impact is that the lower interest rates result in a lower cost of financing for businesses so that more of their potential projects now become feasible. The graph on the right depicts the typical relationship between the interest rate on loanable funds and the current level of business investment. This inverse relationship arises because firms are more willing to expand when interest rates are relatively low. That is, businesses are willing to pursue additional projects now that their cost of financing is lower. The increase in business investment represents new business spending that can stimulate the economy. Many businesses rely on equity as another key source of capital. Monetary policy can also influence the cost of equity. The cost of a firm's equity is based on the risk-free rate plus a risk premium that reflects the sensitivity of the firm's stock price movements to general market movements. In summary, the Fed's ability to stimulate the economy is due to its effects on the Treasury, or risk-free rate, which influences the cost of debt and the cost of equity shown in this exhibit. As the Fed reduces the target federal funds rate, it influences all short-term interest rates, including the risk-free rate, and this reduces the firm's cost of borrowing, which is debt, and a firm's cost of equity, and therefore reduces its overall cost of capital. If a firm's cost of capital is reduced, its required return on its business investment is reduced, and in turn, more of the possible projects that a firm considers will become feasible and will be implemented. Although a stimulative monetary policy is normally desirable when the economy is weak, it's not always effective for a number of reasons, which can include the Fed's limited ability to control long-term interest rates, limited credit provided by banks, low return on savings, adverse effects on inflation, and lagged effects of monetary policy. Next, let's consider the effects of implementing a restrictive monetary policy. When excessive inflation is the main concern, the Fed can implement a restrictive or tight money policy, which will result in a decrease of loanable funds and an increase in market interest rates. As an example, let's assume that the Fed's action causes a decrease of $5 billion in loanable funds. The quantity of loanable funds supplied will now be $5 billion lower at any possible interest rate level. This reflects an inward shift of the supply curve from S1 to S2, as shown in the graph on the left. Given the inward shift in the supply curve for loanable funds, the quantity of loanable funds demanded exceeds the quantity of loanable funds supplied at the original interest rate level I1. In turn, the interest rate will increase to I2, the level at which the quantities of loanable funds supplied and demanded are equal. The higher interest rate level increases the corporate cost of financing new projects and therefore causes a decrease in the level of business investment from B1 to B2 in the graph on the right. As economic growth is slowed by this reduction in business investment, inflationary pressure may be reduced. This exhibit summarizes how the Fed can affect economic conditions through its influence on the supply of loanable funds. The top part of the exhibit illustrates a stimulative or loose money monetary policy intended to boost economic growth, and the bottom part illustrates a restrictive or tight money policy intended to reduce inflation. Now let's discuss trade-offs in monetary policy. Ideally, the Fed would like to achieve both a very low level of unemployment and a very low level of inflation in the United States. The U.S. unemployment rate should be low in a period when U.S. economic conditions are strong. Inflation will likely be relatively high at this time, however, because wages and price levels tend to increase when economic conditions are strong. Conversely, inflation may be lower when economic conditions are weak, but unemployment will be relatively high. It's difficult, if not impossible, for the Fed to cure both problems simultaneously. This trade-off is illustrated in this graph. In this scenario, the Fed can use a very stimulative loose money policy that's expected to result in point A, say 9% inflation and 4% unemployment. Or it can use a highly restrictive tight money policy that's expected to result in point B, 3% inflation and 8% unemployment. Alternatively, it can implement a comprised policy that will result in some point along the curve between A and B. The Fed's assessment of the trade-off between reducing unemployment versus inflation becomes more complicated when fiscal policy is considered. Although the Fed has more power to make decisions without the approval of the presidential administration, its monetary policy is commonly influenced by the administration's fiscal policies. If fiscal policies create large budget deficits, this may place upward pressure on interest rates. And under these conditions, the Fed may be concerned that the higher interest rates caused by the fiscal policy could dampen the economy, and it may therefore feel pressure to use stimulative monetary policy to reduce interest rates. This exhibit presents a framework for explaining how monetary policy and fiscal policies affect interest rates. Although fiscal policy typically shifts the demand for loanable funds, monetary policy normally has a larger impact on the supply of loanable funds. Some well-respected economists have proposed that when weighing the trade-off between inflation and unemployment, the Fed should focus more on controlling inflation than unemployment. The Fed might be better able to control inflation if it could concentrate on inflation without having to worry as much about the unemployment rate. The fifth key concept in the chapter relates to monitoring the impact of monetary policy. The Fed's monetary policy affects many parts of the economy, as shown in this exhibit. The effects of monetary policy can vary based on perspective. Households monitor the Fed because their loan rates and car mortgages will be affected. Firms monitor the Fed because their cost of borrowing from loans and from issuing new bonds will be affected. And the Treasury monitors the Fed because its cost of financing the budget deficit will be affected. Because monetary policy can have a strong influence on interest rates and economic growth, it affects the valuation of most securities traded in financial markets. The type of influence a monetary policy can have on each financial market is summarized in this exhibit. For example, if we consider the money market, where key factors influenced by monetary policy include secondary market values of existing money market securities and yields on newly issued money market securities. Or the foreign exchange market, where monetary policy influences the demand for, and therefore the values of currencies, which affect currency option prices. The last concept in the chapter relates to global monetary policy. Financial market participants must recognize that the type of monetary policy implemented by the Fed is somewhat dependent on various international factors. A weak dollar can stimulate U.S. exports because it reduces the amount of foreign currency needed by foreign companies to obtain dollars to purchase U.S. exports. A weak dollar also discourages U.S. imports because it increases the dollars needed to obtain foreign currency to purchase imports. As a consequence, a weak dollar can stimulate the U.S. economy. Conversely, a strong dollar tends to reduce inflationary pressure but also dampens the U.S. economy. The Fed recognizes that economic conditions are integrated across countries, so it considers prevailing global economic conditions when conducting monetary policy. When global economic conditions are strong, foreign countries purchase more U.S. products and can stimulate the U.S. economy. When global economic conditions are weak, the foreign demand for U.S. products weakens. Finally, each country has its own currency and its own interest rate, which is based on the supply and demand for loanable funds in that currency. Investors residing in one country may attempt to capitalize on high interest rates in another country. If an upward pressure on U.S. interest rates can be offset by foreign inflows of funds, then the Fed may not feel compelled to use a stimulative policy. However, if foreign investors reduce their investment in U.S. securities, the Fed may be forced to intervene so as to prevent interest rates from rising. Given the international integration of money and capital markets, a government's budget deficit can affect interest rates in various countries. This concept, referred to as global crowding out, is illustrated in this exhibit. An increase in the U.S. budget deficit causes an outward shift in the federal government's demand for U.S. funds, and therefore in the aggregate demand for U.S. funds from D1 to D2 in the graph on the left. This crowding out effect forces the U.S. interest rates to move from I1 to I2 if the supply curve S is unchanged. As U.S. rates rise, they attract funds from investors in other countries. As foreign investors use more of their funds to invest in U.S. securities, the supply of available funds in their respective countries declines. Consequently, there is upward pressure on non-U.S. interest rates as well, as shown in the second and third graphs.